What is it about this market that seems to be so confusing for folks? We are at record highs for the stock market, near these historic highs for the bond market. What gives? Who's got it right and who's got it wrong?
Well, they both have it right, of course. Globally, as you know, you hear the number a lot. There are 13 trillion plus in bonds that are negative yielding. Investors are paying for security. They're worried about things. So the bond market has a certain worry about things that can benefit the stock market, in the sense that there's still a feeling in the bond market that inflation everywhere globally will be low for a long time. That's something that has tended to benefit the equity market. And finally, the view on interest rates globally looks like it'll stay intact for a long time, meaning investors in the equity market and other areas of the investment world will be expecting interest rates to stay low in Japan, in Europe, near zero for years. In fact, PIMCO expects the highest level the European Central Bank will have its policy rate at any time in the next 5 years is zero, with an interest rate cut likely by September 12th and perhaps another one next year, so more deeply into negative territory. And that, again, reflects this view on inflation.
Where is the bigger wild card here, Tony, with regard? I mean, the European Central Bank is going to get new leadership. It probably will be Christine Lagarde. The Fed is still under Jay Powell and will be for a while. Is it the Fed or the ECB that you think has the bigger sway on what's happening globally?
It's still the power lies mostly in the Federal Reserve. Still, of course, because of the growth in the world is in China and in America, in terms of the share of GDP change. The big risks lie in whether or not there's a better balancing act, and Christine Lagarde might help in this, between the fiscal authority, the national governments, and the monetary authorities. We see that the Fed, the ECB, and central banks more generally having an inability to spur growth in ways that national governments would like. And so you might see in the years to come more of a push on the fiscal agents to act. And you saw that this week in America with legislation, it looks like, that will promote growth next year more than investors were initially expecting.
Tony, as we talk about the prospect for risk assets, you mentioned the central bank situation globally is supportive for those. Do you expect that to continue in perpetuity if this policy from central banks continues in perpetuity?
It's likely that rates stay near zero, as I mentioned, but the efficacy of monetary policy is diminishing. There is a chance, though, that in the next recession, U.S. interest rates collapse towards 0%. In fact, could even move into negative territory, just as in Europe and Japan. But that's in the next recession, which we don't see for some time. It's more than likely that the U.S. economy will keep expanding into the election because politicians, as we saw this week in Washington, want to keep the economy humming, so to speak, and probably will perform reasonably well into next year. And then it's after that investors will have to start questioning the ability of central banks to keep growth going.